Now we will take up the case of another important subsidiary book known as the cash book. As you know, cash book is also known as a principal book as well as a subsidiary book. So for that you have to understand the meaning of principal book and the meaning of subsidiary book. As you know, subsidiary books are the books of original entry. That means whatever is recorded, it will be recorded first in the subsidiary book and then it will be taken to the principal book. Principal books are normally the ledger accounts. So in the case of a cash book, what happens? Cash book itself will also help you find out the balance in the account. So it is also an account and also it is a subsidiary book. Therefore, it is also known as a principal book as well as a subsidiary book. And normally this is a question which is asked in most of the examinations as to why a cash book is called a subsidiary book as well as a principal book. It is called a principal book because you will be able to ascertain the balance of the account at any point of time, like we do in the case of a ledger account. And it is a subsidiary book because all transactions involving cash receipts and payments are straight away recorded in the cash book. Therefore, it is also a subsidiary book. Now, how these cash books are divided into, we will find out. Normally, there are three types of cash books. One is known as the simple cash book. Second one is known as the 2-column cash book. Third one is known as the 3-column cash book. So let us take up the simple cash book. Simple cash book is like an ordinary account. There will be debit on one side and credit on the other side. It has got one amount column on each side. That means actually there are 2 columns for amounts, one for debit, one for credit. It is called a single column or a simple cash book because there is one column on either side. The left hand side normally records the receipts of cash and the right hand side of the payments in cash. So the specimen looks as one shown in the blackboard. If you look at it, you will find that you have 4 columns under debit and 4 columns under credit. And the columns are same on the debit side and the credit side. So these 4 columns relate to one the date, second is the receipts, third is the ledger folio and fourth is the amount. In the case of credit side, again date, instead of receipts we have payments, then ledger folio and then amount. And the balancing of this is done like any other account. For example, if there are a lot of receipts and lot of credits, they are posted there and at the end of it we take the balance. That means the difference between the 2 sides is taken as the balance in the account. So that is how it is balanced, and then we can use, like I said earlier in our earlier discussions. So wherever there is a shortage, on that side you write to balance brought down or by balance carried down, then it is taken to the next accounting period. So this is a simple cash book which will record only the cash, payments and receipts. And now we go to the double column cash book. So have a look at the screen and you will find that there is one additional column introduced on either side. That is, on the debit side you have one additional column, on the credit side you have one additional column, that is the column related to discount. So one column is added, that is why it is called a double column cash book. That means there are 2 columns on either side of the cash book. On the debit side there are 2 columns for amount and there are 2 columns on the credit side. Under the discount column we write the discount received or paid, and on the amount column you write the amount to which the entry relates to. If it is a cash receipt, it will be recorded on the left side. If it is a cash payment, it is recorded on the right side. So what is the advantage of the double column cash book? Here whatever discounts are paid, made to the customers, or whatever discount is received by the entity from the suppliers is recorded, so that at a glance you will know what is the total amount of discount. This account can be totaled up at any point of time, maybe at the end of the day or depending on the volume at the end of a particular period like a week or a fortnight, and you will know what is the total amount of discount given by the entity and what is the total amount of discount received by the entity. So it aids the bank in this matter. So a double column cash book in a nutshell records all payments and receipts of cash and also all discount payments and discount receipts. And now we go to the 3-column cash book. As the name suggests, there will be 3 columns for the amount in the cash book on either side. So instead of 2 columns, one for discount and one for credit, cash receipt or payment, there will be 1 column for the bank, 1 column for the cash, 1 column for the discount. On the left hand side, in respect of receipts, there will be bank receipts, there will be cash receipt as well as a discount receipt. Similarly, on the payment side, that is on the right hand side, we will have a bank payment, we will have a cash payment and we will have a discount payment. All 3 will be put there. So this again helps us in trying to combine the cash account and the bank account in the form of a cash book. So there is no need to separately maintain a bank account as such in the ledger. So this cash book itself, a 3-column cash book, will also serve the purpose of ascertaining the balances in the bank account. And the balancing is again done as usual by taking the totals of each of the sides, and whichever side has got a higher amount, higher total, that will be the difference between the two will be put on the side which has got a lower total, and the balancing is done and the balance is carried forward to the next accounting year. So let us now try to understand how the cash entries are posted in the cash book. So as we know, the debit side columns of cash and bank indicate receipts. That means on the left hand side, they indicate receipts. Therefore, the amounts debited in the cash book should be credited to the respective accounts in the ledger. So this is slightly confusing normally for many people. So what you have to remember is, cash book, whenever we are recording it on the receipt side, cash is received. That means cash account has been debited. So if you remember the golden rules of accounting, whenever cash is received, we have to debit that account. Debit what comes in, that is the rule for real accounts. So when we are putting it on the credit side, on the debit side, we are debiting the cash account. That means the other leg of the transaction should relate to credit side. For example, if you have received cash from X, you have debited the cash account, so X's account needs to be credited. So when we take the entry to the other account in the ledger, other than a cash account, that respective account should be credited. This you have to remember. Similarly, whatever payments are recorded on the right hand side, they relate to credit. That means cash payments. That means you have credited the cash account. That means the other leg of the transaction should relate to debiting the respective account. Suppose you have paid money to, let us say, XYZ, who is the supplier, in which case cash account has been credited. So you have to debit the respective account of XYZ. So the amounts credited in the cash book should be debited to the respective accounts in the ledger. So this is an important thing which you have to remember. Once you visualize as to what is being done with the cash account, then you can visualize as to what is to be done with the other leg. If cash account is debited, naturally the other account has to be credited. If the cash account is credited, then naturally the other account has to be debited. So in addition to that, we have certain other books kept in the entity in order to minimize the workload. One such book is known as the petty cash book. As you know, number of small payments are required to be made on a regular basis by the entity, maybe to take care of small expenses like postage expenses or purchase of stationery or payment for carriage inwards, etc. So if each entry has to be passed for 10 rupees, 15 rupees or 50 rupees individually, the work will unnecessarily become heavy. So in order to avoid this, it makes sense to record all such transactions where small amounts are being paid, and at the end of a particular period, depending on the volume of transactions, we can pass only one entry in respect of that particular cash, and all other entries, the other leg of the transaction, can be submitted and then those entries can be passed. Normally, as you have seen in the bank, we have a petty cash book which is totaled up every month. So at the end of the month, what we do, we total up all the payments made in cash, and that entire amount is, since it is a payment, it has to be credited to cash account, and the debit will be depending on what payments have been made, and those payments normally are again classified into several heads for the purpose of accounting. For example, if you have paid for traveling, it will be put under traveling. It can be under stationery. It can be under postage. It can be under some other miscellaneous heads. So once we total that, we know that these are the total payments made during the month for these respective heads. So when we credit cash account for the total payments made during the month, all these accounts need to be debited because they relate to the expenditure made in cash. So what happens normally in such cases, we will be passing only one credit entry for cash in a month plus some 5-6 entries in respect of different expenditure heads such as stationery, postage, etc. And the workload will get reduced. You may have made a number of payments during the month, even if the payments may be running into tens and hundreds, still you will have be reducing the workload to a few entries only. So this system of cash book has become very useful to take care of several small payments, and this is how it works. Normally there is a petty cashier who is designated in the entity. He will be given some amount of money at the beginning of the month so that he can meet all the payments during the course of the month as and when they occur, and at the end of the month he will total it up, and whatever balance is left is returned, it is credited back to the account, and in respect of those payments which he has made, they will be debited to the respective account. So petty cash book, we can say, is a kind of a book which will reduce the workload and try to reduce the workload of passing several transactions usually over a period of time to passing only few transactions at the end of a particular period, normally at the end of a month. So in the case of petty cash book, we need to have some checks. That is because certain amount of cash has been entrusted to one person in the entity, normally a petty cashier. So in order to ensure that the money is not misutilized, we need to have some kind of check on the petty cashier. So what it says is, we have to keep in mind the following. One is the amount kept with the petty cash officer or the petty cashier must be just sufficient to meet the petty cash expenses of a relatively short period, normally week, fortnight, or maybe even a month. So that means they should not be entrusted with heavy cash, or it should not be very low also, as otherwise he will have to be made payments every now and then. So it should be sufficient to take care of the duration with which you have decided to close the petty cash account. And you also have to ensure that the person who is making payment will be making payment only against proper authorization. That means there should be some authority who will be authorizing payment to the persons concerned. Payments may be against stationery or against postage or against any other item. That means that responsibility should lie with somebody else other than the person who is making the payments. And payments also, there should be a limit. That means payments beyond a particular amount should not be made through the petty cash. For example, we can fix a limit of, let us say, 100 rupees or maybe even 200 rupees. That means any payment which is in excess of 200 should not be made through the petty cash. So it is to keep a check on the amount of payments being made. And in order to ensure that there is a proper record of all the payments made, he should insist on having vouchers which will be signed by the person who is receiving the cash, and these will be filed chronologically, so that at the end of the month when petty cash account is being closed, it will be possible for the person to check all the transactions on the basis of the vouchers prepared, and this is balanced periodically, normally, as I said, every month, or it could be even a week or a fortnight, and then the amount is verified lying with the petty cashier, so that there is no misuse of the cash entrusted to the petty cashier or the cash officer. So with this we come to the end of the discussion on subsidiary books. Now we will take up another chapter known as capital and revenue expenditures and receipts. This is another important topic, because as we know, all revenue expenses should be treated as expenses of the operations of the business, and they should find their way to the profit and and loss account, whereas capital expenses cannot be taken to the profit and loss account. For example, if you buy a machinery, it is treated as capital expenditure and you cannot account it as an expenditure. So that means it will not be treated as an expense in the profit and loss account. Only a certain portion of that in the form of wear and tear, which we normally call depreciation, will be treated as an amount of expenditure for that particular accounting year. So it is therefore necessary to have proper distinction between the capital expenditure and the revenue expenditures, so that this will help in the proper preparation of the profit and loss account. And if the classification is not done properly, then the profit or loss which is shown in the profit and loss account will not be correct, will not be a true and fair view of the operations of the business. So therefore, we will have to understand the meaning of capital expenditure, understand the meaning of revenue expenditure, and this can be done with the help of certain examples. So let us try to understand the meaning of revenue expenses and capital expenses. As we know, revenue expenses relate to the operations of the business of an accounting period. For example, salary paid to employees or the rent of the premises paid for that accounting period. These are all revenue expenses because they relate to the operations of the business of the entity. Capital expenses, on the other hand, generate enduring benefits and help in revenue generation over more than one accounting period. This definition is very important. Capital asset is one which generate enduring benefits. That means the benefits accruing to the entity from that expenditure will extend to more than one accounting period. For example, if you buy a machinery, that machinery can be used for generation of revenue for the entity for a number of years, depending on the useful life of that particular machine. So if the machinery has got a useful life of 5 years, it will generate revenue for the entity for a period of 5 years. That means it is not a revenue expenditure, it is a capital expenditure because the benefits extend to more than one accounting period. So as per the matching principle, we have to allocate only that expenditure which relates to that particular accounting period. So in the case of a capital expenditure, what can be attributed to that particular period only can be taken. That is what we do when we calculate depreciation. Depreciation is treated as that part of the capital expenditure relating to the machinery which will be attributable to the income generation of a particular accounting period. So that only can be taken as the revenue expenditure. But we have to find out some way of trying to distinguish between capital and revenue expenses. It is not an easy task because it will depend upon a number of factors. Some of these factors are the nature of business, the recurring nature of expenditure, the purpose of expenses, effect of revenue generating capacity of business, and materiality of the amount involved. All these need to be taken into account. To give you just an example, let us take the nature of business. Depending on the nature of business, a particular item may be capital expenditure or a particular item may be revenue expenditure. For example, for a car dealer dealing in cars, any expenditure relating to purchase and sale of cars is a revenue expenditure because that is the business of that dealer. Whereas in the case of any other entity not dealing in cars, a car purchased is a capital expenditure because that has got a useful life of several years and therefore that cannot be treated as a revenue expenditure. So the nature of business itself will decide whether a particular type of expenditure is revenue expenditure or capital expenditure. Similarly, recurring nature of expenditure. Normally, expenses which are of recurring nature are considered to be revenue in nature, but it is not necessary that every expenditure which is recurring in nature has to be revenue expenditure. It again depends on the circumstances of each case. For example, let us say rent being paid by the entity, that is a recurring expenditure, so it is a revenue expenditure. But if suppose the entity sells, let us say a capital asset like building and agrees to receive the payment over a period of time in monthly installments, though that amount is coming in the form of monthly installments, it cannot be treated as a revenue in nature. Or to take the other example of expenditure, if the company buys an asset, a building, and agrees to pay in installments, that installment cannot be treated as expenditure of a revenue nature because it relates to the building which gives enduring benefits to the entity for a particular period of time, that means a number of years. So, depending on the recurring nature of expenditure, normally it is possible to classify expenditure into revenue and capital, but by itself it will not be conclusive proof that a particular recurring expenditure is always a revenue expenditure. It can be in some cases capital expenditure also. Similarly, the purpose of expenses also will give an indication as to whether it is a revenue expenditure or a capital expenditure. Then the effect on revenue generating capacity of business, whatever effect it has, if it has an effect of generating business over an extended period of time, normally such expenditure is treated as capital expenditure. For example, let us take one example of advertisement. Suppose a company is bringing out a new product into the market and they have to advertise heavily to introduce the product in the market. So, whatever benefit they will be getting out of that expenditure will be extended to several periods. So, this can be treated as a capital expenditure. So, we distinguish there as it as a deferred revenue expenditure. That means, though it appears to be revenue in nature, since it is going to give enduring benefits for an extended period, it can be deferred to further periods. So, it is treated as a deferred revenue expenditure, and only that portion of the expenditure which relates to that particular period as per the matching concept will be accounted for as expenditure. Similarly, materiality of the amount involved. So, this goes by the concept of materiality. As we considered earlier, materiality means the significance of that particular amount on the transaction. So, the same amount could be material in respect of one entity and need not be material in respect of another entity. For example, let us take the example of the bank, of which all of you are familiar. For example, we find that when we buy a small calculator for the bank use, which may be costing you about 100 rupees or 500 rupees or even 1000 rupees, it is not shown as a capital expenditure. It is not treated as a fixed asset because the amount involved is so small. Though the calculator is likely to give you enduring benefits for a number of years, at least 2 to 3 years, still it is treated as a revenue expenditure based on the concept of materiality. As the amount involved is small, it is treated as a revenue expenditure and directly debited to the profit and loss account for that particular year. So, materiality also is very important. If the materiality of the amount involved is not very material, that means if the amount is not substantial, then that amount can be treated as revenue expenditure, though by nature it could be actually a capital expenditure. So, now based on our discussion, we can now try to define what is the meaning of capital expenditure, revenue expenditure, what is the meaning of deferred revenue expenditure, similarly what is the meaning of capital receipts, and what is the meaning of revenue receipts. A look at the screen, you will see that capital expenditure is one which contributes to the revenue earning capacity of a business over more than one accounting period. These usually represent acquisition of tangible or intangible fixed assets for enduring future benefits. So, the most important wording in this is it will contribute to the revenue generating capacity of a business over more than one accounting period. So, if the benefit extends to more than one accounting period, such an expenditure is treated as capital expenditure. For example, purchase of a patent. Though it is not tangible in nature, the patent will yield some benefits to the entity over an extended period. So, it is treated as a capital expenditure. Similarly, purchase of machinery or purchase of building. These will extend the revenue earning capacity of the entity to several periods. So, they are treated as capital expenditure. And revenue expenditure on the other hand is one which is incurred to generate revenue for a particular accounting period. That means expenditure is related to that particular period. For example, take the salaries paid to the employees or the rent paid for the building or purchase of raw materials for manufacture of a product. All such things are treated as revenue expenditure because all of them relate to that particular period only. And deferred revenue expenditure, like we consider the earlier cases, is defined as which payment has been made or a liability incurred, but which is carried forward on the presumption that it will be of benefit over a subsequent period or periods. This is shown on the asset side of the balance sheet under the head miscellaneous expenditure. Normally, we give the example of advertisement expenditure, which is incurred, the benefit of which will extend to further periods. Similarly, before the incorporation of the company has to incur a lot of expenditure for doing market research and other things. This is also treated as miscellaneous expenditure, and since whatever information it has collected, research it has done, it will give the benefit over an extended period. It is treated as a deferred revenue expenditure, and only part of that expenditure is allocated on a systematic basis to each of the years. Capital receipts can be defined as receipts which are not revenue in nature. That means all receipts which cannot be treated as capital receipts are treated as revenue receipts. Example capital receipts are receipts from sale of fixed assets. Whenever we sell fixed assets, then investment sales whenever we make them, loans, owners contribution, etc. If you borrow from a bank, that is a capital receipt. It cannot be treated as a revenue expenditure because it is for a particular purpose. Revenue receipts are those receipts which are obtained in the normal course of business. Examples are sale of goods or services, interest income, etc. These are treated as revenue expenditure. So with this we come to the end of this session.